In the late summer of 1973, a quiet meeting reportedly took place inside a small conference room in Zurich. Only a handful of bankers were present, no reporters, no notes shared publicly. Yet the agreement they reached influenced the price of energy, the flow of credit, and the stability of entire national budgets for decades. Most people never heard about it. Most people never realized how often deals like this shaped the world around them. A handshake here, a promise there. A private understanding that never appeared in any official document. These arrangements carried enormous weight. They kept currencies stable through turbulent years. They softened the impact of oil shocks and political tensions. They helped governments borrow money even when their economies were struggling. And at the same time, they created a kind of invisible safety net that ordinary families depended on without ever knowing it existed. A retired accountant once told friends that he suspected something unusual was happening during those years. He remembered how interest rates shifted overnight without clear explanation. He said it felt as if someone somewhere was smoothing out the bumps before they reached the public. He never knew he was partly right. So the real question becomes simple. If quiet deals held parts of the global economy together before, what happens when those same deals begin to strain or break today? There's a calm but important story waiting beneath the surface. And once you see how these arrangements formed, you will notice them in places you never expected. The real story begins long before the Zurich meeting. According to archived banking records, the groundwork was already forming in the late 1950s. The world had just started rebuilding from the damage of 2 long wars. Currencies were fragile. Trade routes were uneven. Many governments were short on gold and short on trust. In this uncertain period, central banks quietly looked for ways to cooperate without drawing attention. A few early conversations reportedly took place in Basel and Paris. These talks were not dramatic. They were practical. They focused on how to keep exchange rates steady and how to prevent sudden shortages of credit. What began as simple coordination slowly turned into a pattern. One institution would signal support for another. Loans would be arranged privately. Gold would move from one vault to another with almost no public explanation. Nothing illegal. Nothing grand. Just small agreements meant to avoid economic shocks. An older economist once shared a memory from that era. He remembered seeing a short cable message that seemed unimportant at the time. It mentioned a temporary credit line offered from one central bank to another. Years later, he realized that message marked the start of a much larger cooperation system. Have you ever noticed how some of the biggest changes in your life began with a detail so small you barely remembered it? This is how the early foundation of today's hidden agreements quietly formed. And soon, these early moves would set the stage for the first major shift in global financial power. By the late 1970s, the first major shift in power began to take shape. The oil crisis of 1979 reportedly pushed governments and banks into urgent private negotiations. Petroleum prices had quadrupled in just a few months. Countries that had been relying on predictable energy costs suddenly faced impossible budgets. Some nations experienced inflation rates above 20%. Insiders allegedly noticed that major banks started offering emergency credit lines to oil-importing countries. One small anecdote comes from a junior banker in London, who recalled a meeting where a single phone call reportedly moved hundreds of millions of dollars overnight to stabilize a struggling economy. It was a quiet transfer, unnoticed by the public, but it shifted power. Financial leverage began to concentrate in unexpected ways. Countries with stable currencies could negotiate favorable terms. Those without had to accept deals that were reportedly less than ideal. This created a subtle hierarchy that insiders could navigate, but ordinary citizens barely understood. Did you ever wonder why some countries seemed to recover quickly from crises while others lagged for years? These early power shifts did more than move money. They set the rules for who could act fast, who could borrow freely, and who had to wait. And this would soon reveal the hidden mechanisms that kept the entire system running until something inevitably tested it. Beneath these shifts, a hidden mechanism quietly guided the flow of money and influence. It was neither public nor advertised. It worked through letters of credit, cross-border agreements, and discrete swap lines between central banks. According to insiders, these tools allowed large sums to move almost instantly, often before markets could react. A real example comes from 1983. The U.S. Federal Reserve reportedly coordinated with the Bank of England to provide liquidity to countries facing debt pressures. No official announcement was made. Yet the action helped prevent defaults that could have triggered a wider financial crisis. For the people managing these systems, the work was precise and often stressful. One retired banker shared how he would receive encrypted messages at odd hours, detailing temporary currency support or credit shifts. He described the process as balancing an invisible scale. The slightest misstep could ripple across continents. Have you ever thought about how so much of the world's stability depends on actions that most of us will never see? This mechanism, hidden from public eyes, connected nations, banks, and economies in ways that were both efficient and fragile. It quietly maintained order while leaving little trace. And yet, as history would show, even the most carefully constructed systems can face consequences nobody expects. The consequence nobody expected began to appear slowly, almost imperceptibly. By the late 1980s, debt levels in several emerging economies had reportedly grown beyond what insiders had anticipated. According to archived IMF data, some countries' external debt had doubled in just 5 years, reaching over $50 billion for nations with much smaller GDPs. Many bankers and government officials allegedly noticed warning signs, but the public remained unaware. In one anecdote, a treasury officer in Mexico recalled reviewing a list of payments that seemed manageable on paper. Yet, in reality, interest obligations were quietly straining the nation's finances. He remembered the tension in the office as they debated whether to ask for emergency support. Ordinary people began to feel the early effects in subtle ways. Prices rose gradually. Imports became more expensive. Loans were harder to secure. Few realized these small changes were connected to complex international agreements quietly unraveling in private offices. Have you ever experienced a time when small, almost invisible pressures slowly changed your daily life without warning? This was the moment when unseen mechanisms met real-world consequences. And what followed would escalate tensions in ways that many insiders reportedly did not predict. By the early 1990s, the situation began to escalate. Debt obligations, interest rates, and currency pressures combined to create tension across continents. According to World Bank records, the total external debt of developing nations surpassed $400 billion by 1992. Some loans had interest rates above 12%, making repayment increasingly difficult. Private deals and emergency credit lines continued, but the scale of the problem was growing faster than anyone had prepared for. One small anecdote comes from a bank clerk in Singapore who recalled frantic messages about stabilizing the ringgit and the rupiah. They worked late nights, arranging transfers that the public never saw. Every move felt like a temporary fix, keeping systems barely balanced. Governments faced choices between austerity measures, new borrowing, or risk of default. Ordinary citizens began feeling inflation, unemployment, and rising costs of essential goods. The invisible system that had once quietly maintained stability now seemed fragile under mounting pressures. Have you ever noticed how small, behind-the-scenes decisions can suddenly affect millions of people without them knowing why? These escalating pressures were moving toward a breaking point. And soon, a critical fracture would appear, testing the resilience of the hidden system itself. The breaking point arrived quietly, but its effects were unmistakable. In 1997, the Asian financial crisis reportedly began in Thailand when the baht collapsed after years of speculative pressure. The government had been defending its currency with reserves that, insiders later admitted, were insufficient for the scale of the problem. Within weeks, neighboring economies from Indonesia to South Korea faced similar crises. Eyewitness accounts from financial analysts in Jakarta described a sudden sense of panic. Phones rang constantly. Funds that had seemed secure were suddenly frozen or redirected. One junior trader recalled staring at numbers on the screen that moved faster than any human could follow. He felt powerless despite knowing the mechanisms that usually maintained balance. Central banks and international institutions intervened. Emergency loans were arranged. Swaps and short-term credit lines were deployed. But the cracks were visible now, no longer hidden. Have you ever watched a system you trusted suddenly show its vulnerabilities and wondered how it could have been so fragile all along? This moment marked a turning point. The invisible rules and private agreements had been tested under real-world pressure. And what became clear was that the hidden pattern guiding these events was far more influential and more fragile than most had ever realized. Looking back, a hidden pattern emerges from these events. Across decades, quiet agreements, emergency credit lines, and private deals repeatedly shaped outcomes before the public even noticed. From the post-war Basel meetings in the 1950s to the Zurich arrangements of the 1970s, and the crisis in Asia during the 1990s, the same mechanism appeared again and again. It was a pattern of unseen support followed by gradual stress, temporary fixes, and eventual exposure. Insiders reportedly relied on discretion, speed, and networks of trust to stabilize economies. Ordinary citizens often saw only the ripple effects, currency shifts, inflation, or sudden policy changes without understanding the underlying cause. Historical parallels are striking. In 1929, some economists argue that private lending and hidden credit flows temporarily masked weaknesses before the Great Depression. In 1973 and 1979, oil shocks triggered hidden interventions that prevented larger collapses. And in 1997, Asia's crisis revealed how quickly even well-tested systems could strain under pressure. Have you ever noticed similar patterns in your own experience? Small, unseen supports carrying the weight until the moment they can't? Once you recognize this pattern, it becomes easier to see how quiet deals, trust, and hidden mechanisms have consistently shaped global events. And this understanding leads naturally to examining the long-term consequences that still echo today. The long-term consequences of these hidden patterns are still visible today. Global finance continues to rely on private agreements, emergency swap lines, and discrete coordination between central banks. According to recent IMF data, over $3 trillion in international liquidity can be moved in a matter of hours through networks few outside the system truly understand. Past decisions continue to shape modern realities. Nations that recovered quickly from crises often had access to discrete support early on. Countries that struggled were sometimes left waiting for intervention, even when official statements suggested stability. Ordinary citizens feel these echoes in higher living costs, changes in interest rates, and fluctuations in savings and pensions. A small example comes from 2008, during the global financial crisis. Some banks received rapid private funding before the public knew the depth of the trouble. A New York trader later recalled the anxious atmosphere in those days, where entire economies hung on decisions made in rooms that ordinary people could not enter. Have you ever considered how much of the stability we take for granted depends on systems operating quietly, largely unseen, and shaped by decisions made decades ago? Recognizing these long-term consequences helps us understand why current policies, currencies, and markets are structured the way they are. And it sets the stage for the final framing of what all of this truly means. The final frame of this story brings the big takeaway into focus. Throughout history, quiet agreements and hidden deals have acted as both glue and pressure valve for the global economy. They have allowed crises to be softened, debts to be managed, and trade to continue, often without public awareness. Yet the same mechanisms that stabilize can also conceal fragility. When pressures accumulate, the cracks appear suddenly, as they did in 1929, 1979, 1997, and 2008. The lesson is clear. Resilience often depends on trust, discretion, and foresight more than on visible rules or public institutions. A historical echo can be seen today in emergency lending during financial turbulence, or in the discrete coordination of central banks during sudden currency shocks. These actions are modern reflections of a pattern that has persisted for over 70 years. As you consider this, ask yourself, how many of the structures we rely on daily are quietly maintained by unseen hands? And what might happen if those hands falter? Understanding this gives a deeper sense of both caution and appreciation. It is a reminder that history, finance, and human decision-making are deeply intertwined. And that even in moments of uncertainty, much of the world quietly continues to function because of the careful, often invisible work of those who came before.